Very good morning, friends. So I hope you are doing well. And of course, most importantly, I hope you made a revision of the questions which we did on consolidation last time. So I know a little bit technical inputs, and I think before we take it further, I am just going to take a quick recap on the critical issues which you need to keep in mind when you're working on the six-step model on making a consolidated balance sheet. So I'd basically given you that when you're approaching a practical illustration on consolidated balance sheet, you got to religiously apply a six-step model. So I think before we take the journey forward and do some more questions with you, because I'm going to do a little more technical questions with you, not very technical indeed, but of course, considering the kind of level we get in the examination, we're going to do questions on that. So first of all, let's take a quick recap on the six-step model, the critical issues which you need to keep in mind under each of these steps. So quick mind map based on your revisions as well. So we started a journey in terms of making a consolidated balance sheet, and I'm making a quick mind map on that. Well, the step number one is pretty simple and straight indeed, because all what you need to do in terms of step number one, identify the date of acquisition as well as the percentage. Well, the question rises, would there be any challenges? Would there be any challenges in terms of identifying the date of acquisition or the percentage? I would say no. Because in this particular case, the date of acquisition will be very apparently given and the percentage would also be very apparently given. So I don't see any challenge in terms of step number one, unless it becomes a case of step acquisition. And even if it becomes a case of step acquisition, naturally, my date of acquisition is going to be considered when you achieved a control. So that is going to be the second date of acquisition. So per se, I don't see any challenges. Then we go on to the step number two, and here we need to be very careful when we're working in terms of step number two. Now, when you're working in terms of the step number two, my piece of advice is that first of all, look at the category of the question. Is it a question where you're required to make a consolidated balance sheet on acquisition date, or is it at a later date? So at the first instance, you should watch out and look at the question carefully. Okay, let me just change the shape. So in this particular case, when you're looking in terms of the step number two, first watch out the category of the question. Is the question asking you to make a consolidated balance sheet on date of acquisition itself, or is it asking you to make a consolidated balance sheet at a later date, maybe 1 year later, or maybe a couple of years later? So these are the only two categories of question. Now, if it is a question where you're required to make a consolidated balance sheet on acquisition date itself, life is simple. Because in this particular case, what I can do, I will directly get the list of net assets at a fair value. We will directly get the list of the net assets at a fair value. If you remember the questions which we did in the previous class, we were given the assets and liabilities and the fair value. So we just made a list of assets minus liability, getting the net assets, simple and straight. But if you're looking at a question where you're required to make a consolidated balance sheet later, then there are two sub-steps which you are required to do. Well, in this particular case, the first focus is we're not going to get the net assets as assets minus liability. In this particular case, we're going to consider the net assets as equity share capital plus a pre-acquisition profit. So in this particular case, what is important is that in step number A, you do the analysis of other equity. You do the analysis of other equity, and then you get the net assets at fair value. And when you get the net assets at fair value, it is the sum total of the equity share capital and the pre-acquisition profits, which you've got from the analysis. So in this case, you need to split your things in terms of two steps, get the analysis, that is one, and then you need to get the sum total of the share capital and the pre-acquisition profits. Now, Coming to a bit on the focus points in terms of analysis of equity, I told you when you do the analysis of equity, you've got certain focus points here as well. So let's be very careful that when you're looking at the analysis, then there are certain major focus points, and I've given you a total of 3 focus points. Whenever you do the analysis of equity, I would say go in 3 phases. Number 1, look at the balance sheet of the subsidiary. So focus on the balance sheet of the subsidiary and see the other equity of the subsidiary company. So whatever is the other equity in the balance sheet of the subsidiary, be it retained earnings, be it other comprehensive income, you need to make an analysis of each and every component of other equity in the balance sheet of the subsidiary. Make your time scales and get the inputs at the beginning and at the end of the year, or on the date of acquisition at the end of the year. Very carefully do your analysis. Look at the balances which are pre, get the increase, see, is it in a time ratio? Is it supposed to be taken as post-acquisition? That is focus point 1. Second, since we need to get the net assets at a fair value, so what is also to be done, you need to consider the fair value adjustments as a part of the analysis. And all these fair value adjustments will always be considered pre-acquisition in nature. So you got to look at the additional information, and in the additional information, look at for the fair value adjustments, if any. I'm not saying that there will always be fair value adjustments, but you need to look into the additional information and go through that whatever fair value adjustments are given, pick them up. And the caution in this particular case is when you consider the fair value adjustments, in this case, the fair value increase or decrease is always pre-acquisition in nature. This will always enter in the pre-acquisition column. And you also need to consider the impact of any additional or the reversal of excess depreciation as well. Here, mind the words, what I'm saying, if there is an increase in the fair value, it would lead to an additional depreciation in a post-acquisition period. And if there is a decrease in the fair value, then there is a need to reverse the excess depreciation in a post-acquisition period. So this will always be taken as post-acquisition in nature. Because when you're going to change the value of the asset, the depreciation is going to undergo a change on a prospective basis. So the depreciation will always be post and the fair value changes will always be pre. And the third focus point, what we need to keep in mind is, again, look at the additional information and there could be an unrealized profits information given. Now, if there is any unrealized profits information given, remember it was upstream or downstream in nature. In this analysis of equity, you need to consider only what is upstream. The downstream will be directly taken later when you get the other equity in the consolidated balance sheet. So when you scrutinize the additional information in this particular case, you need to consider the stock reserve. And in terms of the stock reserve unrealized profit, we are looking at only the upstream transactions in this particular case. So as we did the questions, we identify these focus points. So remember, in the analysis of equity, these are the minimum focus points. So whenever you do a question, your mind should be very clear that I'm looking at number 1, the analysis of the other equity. I'm looking at the fair value adjustments in the additional information and any unrealized profits, but that is upstream in nature. So make your scrutiny and get your analysis in this case, and then get the net assets. So that was the main focus point in terms of step number 2. Yes, apart from this, there is going to be a dividend point as well. And when you're looking at the analysis of the other equity, I would say in this analysis of other equity, be a little careful on the dividends as well. And as I said, if you are given any dividends in the additional information, the subsidiary made a payment of dividends, my advice was to get in the pre-column the figure which is before dividend. So when you get the figure in the pre-acquisition column, I'll give you the logic once I come to, again, the calculation of goodwill in ICAI. But remember, when you do the analysis and get the pre-acquisition figure, get the figure which is before dividends. Because I need the information which is supposed to be net assets on the date of acquisition. So remember, in terms of dividend, your focus points needs to be clear. You need to get the figure which is without reducing any dividends. Okay, so this was step number 2. And then further, we went on to the step number 3. And in terms of the step number 3, now I'm going to go give you a little more inputs as well. Because since we are making a little mind map before we go on to some practice. So now when you're looking in terms of NCI, you need to consider a set format. You need to consider the NCI on the date of acquisition, and which is going to be purely as per Ind AS 103. So you will calculate this NCI on the date of acquisition purely based on what you've learned in Ind AS 103, which means that in this case, you get a choice of either a fair value or you could consider the proportionate share in the net assets, that is PASNA. Now, these instructions will be very clearly given in the question. The examiner would clearly tell you that which particular method are we using. I would say if the question is apparently giving you a fair value per share of the subsidiary company, I'm not saying fair value of the parent company. If the question gives you the fair value per share for the subsidiary company, it is indicative that NCI is taken at a fair value. Otherwise, if fair value information is missing, then you need to consider PASNA. So PASNA would be used in a situation where we can say the fair value per share of subsidiary company. The fair value per share of the subsidiary company is not given in the question. So if it is not given in the question, then we are going to use the PASNA. And since you've already got the list of the net assets, in the previous step, you just take the net assets into the percentage held by the NCI. Now, a little caution what we need at this particular stage. So a little caution at this particular stage is when you're going to consider the NCI at a fair value or a PASNA, when you're going to consider the NCI at a fair value or PASNA, immediately your mind should also come into one thing, that if you're taking NCI at a fair value, you're going to get a full goodwill. And if you're going to consider NCI at PASNA, you're going to get a partial goodwill. Now, how does this help me? You're going to see today in one of the questions I'll do. If you're going to get a full goodwill, and if there is impairment, if any, the goodwill impairment is borne by the NCI and the parent both. But if the goodwill is partial, the impairment, if any, is borne by the parent company only. So it is very important when you trigger the thoughts that NCI is at fair value or PASNA, your thought should become very clear that if it is a full goodwill, in this particular case, the impairment loss is going to be borne by the holding company and the NCI both. But if it is a partial goodwill, then the impairment loss is borne by the holding company only. So that's another point which should immediately click your mind. That if I am given any inputs regarding the goodwill impairment, I need to take a hit at which places. Okay. Further, once you've taken care of the NCI on the date of acquisition, you need to add the share of NCI in post-acquisition profits. You need to add the share of the NCI in the post-acquisition profits. You've already done the analysis in terms of step number 2A. And in terms of step number 2A, you get the post-acquisition figure and you take the NCI percentage. So this is what you're going to get from the step number 2A, that is analysis of the equity. And I would say, since we are working on a complete inputs, you should also reduce the impairment of goodwill. You also need to reduce the impairment of goodwill, which is NCI's share. Which is NCI share if NCI is at fair value. If the NCI is at a fair value, your mind should be working very sharp in terms of what is to be done at each stage. Every step, your focus points need to be clear. Your focus NCI is at fair value pasna. You decide a goodwill is full or partial, and you need to reduce the goodwill impairment only if the NCI is taken at a fair value, and that's how you're going to get the NCI on the date of acquisition. Now, another focus point, the most important focus points when a dividend comes into play. So when a dividend comes into play, then you've got another focus points in this case. As I said, this NCI ultimately is being calculated on the balance sheet date. The ultimate objective is you're calculating the step number 3, which is the NCI as on the balance sheet date. So remember, when you're going to consider the NCI on the date of acquisition, and if you're using PASNA, if you're using fair value, then it's not an issue. Because if you're taking NCI at a fair value, dividend doesn't bother me. It is only if you're taking your NCI at a proportionate share in the net assets, you need to be careful that you need to consider the net assets, which is after dividends. The net asset, which is after dividends. So my advice is another point. I would advise that you can do something which will, help you, that you never ever go wrong. So I would say that in terms of step number 2B, when you calculate the net assets, I would say when you're doing the step number 2B, when you're calculating the net assets, if you are given dividends information, why not organize 2 net assets at that stage? One is a net assets before dividend and one is a net assets after dividend. This is going to be very helpful. So I would say if you are given any dividend information in the question, organize the net assets, which is before dividends, and also organize the net assets after dividend, because you'll be very clear when you go to calculate the NCI and the goodwill, your mind will be very clear which net assets am I supposed to pick up. So I would advise the moment you see a dividend, you get your focus points clear. Boss, I need to get 2 net assets on a safe side. One is a net assets without reducing dividends, which is for goodwill calculation. And one is the net assets after dividend, which is for the NCI calculations. So you would need 2 net assets, one for the goodwill before dividend and one for the NCI, that is after dividend. Focus becomes even more strong. So these are the crucial points to be kept in. And as I said, I've already given that you need to consider the net assets after dividends in terms of NCI. I know early in the morning, I am giving you a complete mind map based on our discussions in the previous class itself. So when I do the questions, your mind is working very sharp in terms of what all you need to do under each step. Because, at the end of the day, it's almost a mathematical exercise once you know the logics, but you just need to be clear in terms of what is done at each stage. Then life is simple. Okay, so this was step number 3. Then we go on to the step number 4. Then we go on to the step number 4. And in terms of the step number 4, you need to calculate a goodwill. Now, as I said, I'm just adding a few flavors as well, especially the concept of goodwill impairment. So in the step number 4, when you're calculating a goodwill or a bargain purchase gain, which is nothing but indirectly, you can say it's a capital reserve. So in this particular case, you need to follow exactly what you did in IND AS 103, 100% same as IND AS 103. So in this particular case, it is 100% same as IND AS 103. It is going to be 100% same what you did in terms of IND AS 103. So what did we do in terms of 103? You're going to consider the purchase consideration, which is nothing but the investment which the holding has in the subsidiary. Now, caution, caution. Because you're going to see this element today in certain questions as well. Examiner would sometimes test you. He will give you the investment in the balance sheet of the parent, but what he will do? He will give you certain considerations, like, for example, a deferred consideration, like, for example, a contingent consideration, which has not been captured as a part of the investment. So you need to be careful that when you consider this investment, don't just be, just don't pick up this figure from the balance sheet of the parent. You need to see if there is any omissions in terms of consideration, because he might give you that this investment in the balance sheet is only the cash or only the equity shares given to the shareholders. But there must have been some DC, a deferred consideration, or a CC, which is not yet incorporated. I remember one of the examination questions was there where the consideration also included a deferred consideration, and the deferred consideration was never recorded in the separate financials of the parent. So when you consider this investment, also watch out if there is any omissions or not. Also watch out if there is any omissions, if any. Was there any consideration DC or maybe a CC which is not a part of the investment appearing in the balance sheet? That's going to be very helpful indeed. And once you take the PC, you're going to add the NCI, what you've already taken in terms of step number 3. But as I said earlier in the previous class as well, don't do this mistake. In this case, when you are doing, because when you were doing Ind AS 103, everything was done on acquisition date. So in this particular case, you used to pick up the NCI from the previous step itself. But in this case, it'll be dangerous to pick this from step number 3, especially if your NCI is at PASNA. It'll be dangerous to pick this information from step number 3, especially if your NCI is at PASNA, because now I need the net assets, which is before dividends. For NCI, I took the net assets, which is after dividends, because I need the information on the balance sheet date. In this case, I need on the acquisition date. So you're going to consider this on the basis of net asset that is before dividends. You're going to consider the figure of the NCI, which is before dividend. Your mind needs to be very powerfully thinking that if it is goodwill before dividend, if it is NCI, I need figures after dividend. So dividends, you need to be careful on. So once you add the PC and the NCI put together, then we're going to get a figure, and we're going to compare this with the net assets at a fair value, which you've already computed in terms of step number 2B. Which you've already computed in terms of step number 2B. So the sum total of this is compared to the step number 2B, and you're going to get a goodwill or a bargain purchase gain. Now, once you get this particular figure, that is the goodwill. So once you get this particular figure, that is the goodwill, please don't stop here. I'm giving you a mind map, your thought processes. Don't worry, I'll quickly run through the step model as well. I'm giving you the critical points, what you need to keep in mind when you attack a comprehensive question. Now, once you get the figure of goodwill, what do you need to do further? You need to reduce the impairment loss of goodwill as well. Now, this is one of the most common mistakes which many students do at time, and that is they start thinking whether the goodwill is full or partial in nature, and do we need to reduce the entire goodwill, or do we need to reduce the parent share? Well, let me tell you, you're calculating a goodwill. So at this stage, when you're considering impairment, I am not concerned with the fact whether it is a full goodwill. I'm not concerned with the fact whether it is a partial goodwill. You need to reduce the entire impairment loss. I need the figure. I need the final figure of goodwill. So I don't need to consider that I'm going to reduce the parent company share or the NCI parent both. In this case, I'm not concerned. NCI, when you took the goodwill impairment hit, it was necessary to decide that NCI is based on fair value PASNA. Because whether NCI is going to bear the impairment or not. In this case, I don't need to decide, goodwill is full or partial. Whatever is the impairment loss of goodwill, just reduce that and you get the final figure. and you get the final figure, which is going to be shown in the consolidated balance sheet. So this is the focus points in terms of the step number 4. Now comes the step number 5. I'm intentionally spending a good time with you. I know it's almost 25 minutes, and I'm spending another 5 minutes on this because this half an hour is the most crucial step, because this will give you a complete focus points in terms of doing questions. Okay, so let's go on to the next step now, and that is step number 5. Well, many people skip the step number 5, that I'll directly manage this in the balance sheet itself. And my advice is don't do that, because every step will organize the data sequentially and on a very safe side. So don't be in a hurry and try to organize the other equity, which is going to be presented in the consolidated balance sheet. So your step 5 is very crucial because you need to consider the other equity, which will appear in the consolidated balance sheet. Now, my advice is that when you're making this other equity statement, I would advise that certain things you need to be careful on, and why not make an extract SOKI? So when you make this step number 5, let's organize the data carefully, and let's consider one column for retained earnings, and let's consider another column for other components of equity, and maybe if there is a capital reserve, if any. Maybe there is a capital reserve which comes out of the goodwill or capital reserve calculations. So consider making a column for RE, other components of equity, and the capital reserve, if any. Now, when you go to consider the step number 5, there are again certain focus points. And I would say you've got a total of 3 focus points again. Apart from a base, you've got 3 focus points, minimum 3 focus points, which we need to consider. The list could increase, but there is minimum focus points. So as a base, what do you need to consider? You need to consider holding companies' own retained earnings and other components of equity, which will be available in the parent company's balance sheet. You look at the separate financials of the parent, and the retained earnings and the other components of the parent would be given clearly. And then you need to consider again 3 focus points, as I said. So we'll get now a total of 3 focus points again. So what are the 3 focus points to be kept in mind as we turn forward? In this particular case, I would say number 1. The focus point number 1 is you need to consider holding share in subsidiary post-acquisition earnings. The first focus point is you need to consider holding company share in the post-acquisition profits. And typically, you will get a post-acquisition share in RE, or maybe a post-acquisition share in other components. And this information is available from the analysis of equity. That is step number 2A. Your step number 2A will become the focus to pick up the holding share in subsidiary post-acquisition profits in this particular case. Then the second focus point is looking at the stock reserve. And this time, the unrealized profit, which is in the additional information, got to be downstream. Because upstream was already taken in the analysis of equity. Now your focus point is to pick up the stock reserve, which is available in the additional information downstream in nature. And this unrealized profit is going to be reduced out of the retained earnings column, not out of the other components. So one focus point is the post-acquisition earnings. Second focus point is the unrealized profits, that is downstream, not upstream. Then there is a third focus point, and that would be dividends, which the holding company received from the subsidiary, and that needs to be eliminated as well. Because from a group point of view, it's not an income. The parent company must have taken this dividend as a part of its earnings, but it's not an income from the group point of view. So you need to eliminate the dividends which the parent has received from the subsidiary. And this will also be eliminated from the retained earning column. And this capital reserve, if any, is going to come from the step number 4, that is goodwill or bargain purchase gain. So this is the minimum 3 points which you need to consider in terms of calculating other equity. Trust me, if you go on a step-by-step basis, you're bound that you will not go wrong, because your focus points becomes very clear what is the considerations to be kept at each stage. So that was step number 5, and then finally we go on to the step number 6. And when you come to the step number 6, you're finally making a consolidated balance sheet. And when you're making a consolidated balance sheet, you just need to keep those 5 rules which I've given you earlier. I'm not going to document them again. So you just need to keep those 5 rules of consolidations which I gave you. Investments not to appear, and equity share capital of the subsidiary not to appear. Other equity pre will not appear. Post is split between parent NCI. Aggregation of all the assets and liability irrespective of the percentage. And we said goodwill NCI to be reflected as a separate line items. So these are certain focus points. But apart from this, what you need to keep in mind is the adjustments. Like, for example, you need to incorporate the fair value adjustments, and you also need to incorporate the additional or the excess depreciations as a part of the assets. Because in the additional information, you would have taken care of the fair value adjustments. So when you consider the assets and liability, consider the fair value adjustments and excess depreciation. Remember to take care of the stock reserve from the figure of stock upstream or downstream irrespective. Because stock is yet to be reduced, so you need to take care of the stock reserve unrealized profits. Take care of the effect of any intercompany owings as well. So again, we get another 3 focus points out here as well. Wow. So minimum of 3 adjustments which you need to take care at this stage as well. Right, friends, so that is the focus points. I hope this really helps you. I think my inputs in terms of what I've done so far is going to be quite helpful indeed. So let me just quickly take 2 minutes to consolidate the main focus points in 6 steps. Then we are ready to start with a practice with you. So let me just quickly make a run through of all this with you. So remember, when you are attacking a question on a consolidated balance sheet, we're going to talk of consolidated income statement also very soon. In one of the questions, first the focus is a balance sheet. So we know that in terms of balance sheet, we've got a 6 steps model which we need to apply in terms of consolidation. Step 1, there is hardly anything, no focus points. Practically get the acquisition date and the percentage, that's it. Now the main focus points in terms of step 2, look at the category of the question first of all. See, do you need to do 2 steps in the step number 2 or just a single step? It all depends upon the fact. If you're making a consolidated balance sheet on acquisition date, you will directly get the net assets at a fair value. Life becomes simple, nothing major. When you're making a consolidated balance sheet at a later date, in this particular case, you got to make analysis of equity, 1, and you need to get the sum total of the share capital and pre-acquisition. Analysis of equity, you got 3 focus points coming in. You need to consider the analysis of other equity. You need to consider fair value adjustments with additional depreciations and fair value in the pre-additional depreciation post. And you need to consider stock reserve if it is upstream in nature. And of course, the dividends is going to be something which will bother you. So once a dividend is given in the question, remember to make a list of 2 net assets. 1 is without reducing dividend and 1 is after reducing dividend. Then in terms of step number 3, you just need to focus on the NCI. Is it fair value plus now, so that we can identify goodwill is full partial, because that is going to impact the impairment testing. When you go to consider the NCI, remember the focus is the net assets after dividend, because I need the NCI as on the consolidated balance sheet date. So we need the figures of net assets after dividend. At the share of the NCI, reduce the impairment only and only if the goodwill is full in nature. That means NCI at a fair value. Okay, and then it reminds me of the point as well. which I'll just add on. In terms of step number 4, your calculations of goodwill is exactly similar. Be a little careful. PC is investment in the balance sheet of the parent. But remember, if there is any omissions which are not a part of the investments, DCCC, we just need to be a little careful on that omissions. And also remember that in this case, when you take the NCI, please don't take NCI on step 3, especially if the NCI is at PASNA, because we need the NCI based on the net assets before dividend. And even when you go to consider the net assets at a fair value, this is also supposed to be before dividends itself. This is also supposed to be before dividends itself. And remember, you need to make a reduction of the goodwill impairment, irrespective it is full or partial. Whatever is the goodwill impairment, just reduce that. Then in terms of the step number 5, we've taken care of these things, but let me just also add another thing as well. Just a little more focus point number 4 as well. If there is any impairment loss of goodwill, if there is any impairment loss of goodwill, you need to reduce this from the RE as well. But this will be holding company share only. This is going to be holding company share only, because this is the other equity of the parent company. So you need to consider that there might be a goodwill impairment loss as well. So whatever is the parent share, we will reduce it from the RE. That becomes more like a focus point 4. So you need to consider the 4 focus points. One is the post-acquisition earnings, then there is stock reserve downstream, then there is dividend eliminations, and there is goodwill impairment loss. So you know what is to be taken care of. And finally, in the balance sheet, the 5 rules, along with the impact of stock reserve, fair value adjustments and additional depreciations, and the elimination of the intercompany owings. I guess, friends, I am pretty much clear on the concepts, the focus points under each step. Okay, I think now we are ready to start with it. So I think let me see if there are any questions coming in the meantime. Otherwise, we stop off. And Shruti tells me, thank you so much, sir. You're most welcome. That's great. I hope this effort helps. I was a little apprehensive, spending almost half an hour with you in the morning trying to consolidate things. But then I thought it's worth it. Because if I don't do this and I start doing questions, we may not be able to get the documentation in terms of the key focus points. I hope my thought processes were correct, I believe. Okay, so now with this, we can go on further. And we are now going to do some questions with you. This is a question which is from the study material unit number 8. So this is a question which is study material unit number 8. I think it's good to see. Now, whatever we have learned, we are going to do 2-3 questions with you. If you remember, last time I did case 1, case 2, and case 3, but I didn't do case 4. I did a questions where we did consolidation on acquisition date with without NCI. I did a question where there was a consolidation later without NCI, but now we're doing the comprehensive case, which is consolidation later with an NCI. And then we'll get on to some more practice with you. So today is going to be very important because whatever questions I'm going to do with you is going to give you a complete hang on things. Trust me. Okay, so you can just open this in the study material as well. Okay, Yadu, you said, sir, in step number 5, reducing dividends from other equity. Sir, you said this is a group income that needs to be eliminated. Kindly elaborate this. I'm not getting a reason to eliminate this. Kindly explain. Sorry for the extra trouble. No problems. I'll do that. Tanisha, thank you so much for making things for us. Thank you, Tanisha. That means a lot. Okay, let me tell you, Yadu. When I came to the step number 5, I said we need to eliminate the dividends as well. Now, let me tell you why we are eliminating this dividend. The parent company, the holding company's own retained earnings is including the dividend it received from the subsidiary. I put it again. The parent company's retained earning includes the dividend income received from the subsidiary. But is this income from the group point of view? It's like my subsidiary pays me a dividend and I add it to my retained earnings. But is it an income from an outsider? No. It's an income from the group company itself. So you can say it's like, you are getting some money from the subsidiary company and you're putting it as a part of your separate financials, but it is not income from the group point of view. Because when you consolidate the results of the parent and subsidiary, then whatever dividend is included in this RE is getting eliminated from here because this income is not an income for the group. You receive this income from yourself because it's a consolidated financials. In separate, it is your income, but for consolidation, it is not your income. So by reducing this figure, you are basically reducing what is included in the RE. Right? I guess, I hope you've got your answer on that, right? Okay, so on that note, now let's come back to the question with you. So we are on question number 5, that is in the study material unit number 8. So you can just keep the question in front of you. Study material unit number 8 in TYU, test your knowledge. TYK, test your knowledge. Just look at the question number 5. Okay, let me now read the question to you. We're going to carefully read this question, apply the 6 steps we did. It says Ram acquired 60% ordinary shares of Krishan Limited on 1st October X1. 60% means NCI. And the acquisition date is 1st October X1, and we're given the balance sheet on 31st March X2. I guess undoubtedly things would be very clear. The acquisition date is 1st October, the balance sheet is 31st March, and there is a 60% stake, so it becomes a case 4. There is a consolidation later with an NCI, so this is indirectly my case number 4, which I gave you last to last class perhaps. So this is the case 4. NCI with a consolidation later. So we're given the balance sheet of Ram and Krishan, and then it says retained earnings of Krishan shows a credit balance of 60,000 on 1st April, out of which a dividend of 10% is paid. The moment I read about dividend, my mind starts working on dividends. I need a net assets before dividends. I need a net assets after dividend. For Goodwill, I need a net assets before dividend. For NCI, I need a net assets after dividends. Ram has credited the dividends received to the retained earnings. The parent company took this as a part of its RE, but from the group point of view, you're receiving income from yourself, so it needs to be eliminated as well. The fair value of the plant and machinery is given, the depreciation rates are given, and following are the increases on comparison of the fair value as per Ind AS with the book value on 1st October, which are to be considered while consolidating the balance sheet. So these giving you a list of all the fair value adjustments. Okay, and then further, after giving you the fair value adjustments further, I am given more inputs. And this is something which is given in the notes. It may be assumed that the inventory is still unsold, because if the inventory is not yet unsold, then I would not consider the fair value increase in the balance sheet. Because when I'm going to make a consolidated balance sheet and I'm going to increase the inventory because of this fair value increase, that means it is still unsold on the balance sheet date. And the trade payables are also not yet settled because I'm going to incorporate the fair value changes of inventory and the fair value changes of trade payable in the consolidated balance sheet as well. Also assume that the other reserves on balance sheet date are same as at the beginning of the year. We're required to make a consolidated balance sheet. So I think we can see that there is no stock reserve, there is no goodwill impairment, only fair value adjustments. The focus is now clear. Trust me, as I do this question, if you're able to quickly, keep the focus points which I've given you, trust me, you have got the art of consolidating a balance sheet. Trust me, because this is one of, you can say, a kind of a superior kind of question in the exam. Though, of course, I was just going through one of the questions which is there in one of the papers, GFRS, and I saw one of the questions which is given in GFRS, which is a very, very comprehensive question indeed. Though I think that kind of question cannot come in financial reporting, considering the weightage of the question as well. But it is such a brilliant question indeed that it has got all the combinations which you can think of. A consolidated balance sheet, a consolidated income statement with the concept of deferred tax, with the concept of deferred consideration, contingent consideration, whatnot. It's exactly a question, which is a very comprehensive one. I would have done that question, but doing that question would take at least around 1.5 or 2 hours to do, and I think we can't afford to spend that time. So if you're interested, you can look at that question, which is, I think, called a name Chitkara or something. It's a wonderful question indeed. Maybe I can let you know tomorrow if you want to do a little extra practice on that. Okay, so let's, I think, now begin the exercise with you. We're going to make a run of all these 6 steps, step by step, keeping the focus points clear. So in between, of course, you can answer the questions as well. Okay, Yadu, so making sense now. Thank you. That's wonderful. Appreciated all your guidance and patience. You're most welcome. Tanisha said, so starting point of the question is not visible. This question is similar to the last question, except NCI figures are also similar. You're absolutely right, Shruti. In fact, this question is exactly similar to what we did in the previous one. The only element of NCI is got added. That's it. So let me begin the answer to the question number 5. This is the answer to the question number 5 in the test your knowledge. Let's now begin. So I would advise, please keep the question in front of you. And this is the study material. So let's begin the journey. So we are working on step number 1, where I just need to identify the date of acquisition and the percentage. That's it. So we need to get the date of acquisition and we need to get the percentage. And that is clearly given in the question. So I am clearly given the date of acquisition is 1st October X1. And we are given the percentage is 60%. So my step number 1 is done. There is no complication in terms of step 1. Now let's go to the step number 2. And when I go to the step number 2, we need to look at the category of the question. So we know that this is a question which involves making a balance sheet later. So we need to do 2 steps. Step number 2A, which is on the analysis of equity. So we need the analysis of other equity. So let's first make a diagrammatic chart before we start with the analysis. Let's take a column for the particulars and a column for the pre and the post acquisitions. And then we'll go on the 3 focus points. So this is pre-acquisition. So this is going to be, when I consider pre-acquisition, this is pre-1st October X1. And we consider the post-acquisition profits. This is going to be from the date of acquisition, 1st October X1, till the balance sheet date, that is March X2. So at this stage, you should also find out that as far as the current year is concerned, 6 months of the current year is pre and 6 months of the current year is post. And this is the particulars column. So let's begin with the focus point number 1. We're going to consider, first of all, the balance sheet of the subsidiary. Let's see the other equity of the subsidiary and do the analysis. So go to the balance sheet of the subsidiary. We can see in the balance sheet, there is other reserves and there is retained earnings. So as a part of the other equity, we've got 2 components, other reserves and RE. So let's begin the journey in terms of other reserves. And as I said in the previous class as well, don't be in a hurry, but just first make a time scale and get the inputs, organize it very well. So my financial year is April X1, ends on March X2, and the date of acquisition is 1st October X1. So let's first of all note down the figures on each and every date. In the balance sheet, the other reserves is appearing to the extent of 2 lakhs. And if you notice in the additional information, what is given in the point number 2, the other reserves on 31st March X2 is the same on 1st April X1. So this other reserves, even at the beginning of the year, was same. So there has been no movements in terms of reserve during the year. So that was the balance at the beginning of the year, and it remained the same at the end of the year. There has been no change in this. So we can comfortably say the entire 2 lakhs becomes pre-acquisition in nature because it was a balance on 1st April earned in the pre-acquisition period and is still available. Okay, now let's take the extension of this analysis. So same columns continued, particulars pre and post. So now we're going to consider the next analysis of the retained earnings. And let's consider a time scale as well. Go systematically, you'll never go wrong. 1st April X1, 31st March X2, and the date of acquisition is 1st October X1. So let's look at the additional information and the balance sheet of the subsidiary, get the figures. The retained earnings on the balance sheet date is 1,64,000. This is the retained earnings on the balance sheet date. Now, if you go to the additional information, it says retained earnings of Krishan shows a credit balance of 60,000, out of which a 10% dividend is paid. So the balance at the beginning of the year is 60, and we paid a dividends out of this. Now, the moment you get a dividend, your mind needs to focus that for the purposes of getting the net assets before dividend, when you write the figure in the outer column, you write 60,000, which is before dividends. You write the figure which is supposed to be before dividends because I need the net assets which is before dividend. But before you get the increase, you know that this is without reducing dividend, this is after reducing dividend, it is not comparable. So now let's make a reduction of the dividends paid to see what is still available. The subsidiary company in the balance sheet has got a share capital of 4 lakh. And they paid a 10% dividend on 4 lakh rupees. So on 4 lakh, you paid a 10% dividend, that is 40,000. So what is still available is 20. But as I said, in the outer column, I've not written the figure of 20. I've written the figure which is without reducing dividends. Now you can see the increase in terms of the profits. So this 20 is after dividend, 164 is after dividend. So the increase of 144 is supposed to be the profits earned during the year. And since the current year is 6 months pre and 6 months post, you divide this in the time ratio, that is 1:1, 72,000 and 72,000. And if you want, you can put a column retained earnings, because this is the increase in post-acquisition earnings. We'll do a line-by-line addition later. So I've created a column RE. Retained earnings done. The focus point number 1 is done. We have taken care of the other equity in the balance sheet of the subsidiary. Now we need to consider the second phase, that is the fair value adjustment. So I think let's take it further. Let's go for the extension of this analysis. So a column for the particulars, pre and post. And now let's go to the next phase. And we are considering the fair value adjustments in the additional information. So once you're done with the inputs in terms of other equity in the balance sheet of the subsidiary, RE done, other reserve done, focus shifts to additional information, fair value adjustments. Now, in the fair value adjustments, we are given the machinery status with a depreciation. So get your time scale. So when you're looking in terms of plant and machinery, get your time scale first of all. Let's get the data very carefully on each date. So this is 1st April X1 and this is 31st March X2. And the date of acquisition is 1st October X1. Let's get the figures very clear. Making of your time scale is going to be very important because it'll give you a track of the figures on each date. Okay, so now let's, I think, go to the additional information. The fair value of this machinery on 1st October X1 is 4 lakhs. So the fair value on the date of acquisition is 4 lakh. If you go to the balance sheet of the subsidiary, the plant and machinery is appearing at 2.7 lakh. So this is the book value, 2.7 lakhs at the end of the year. And I think you will remember similar calculations being done. My depreciation rate is at the rate of 10%, which means 2.7 lakh represents 90% because that is after taking a 10% depreciation. So if this represents 90%, gross it up. So this is 90. So what is 100% is 3 lakh. And then we need to get the book value at the middle of the year. So from this 3 lakh, you're going to reduce a 10% depreciation, that is 30,000 for 6 months. Because we need to get the status of the book value on 1st October X1. So just take a 6 months depreciation, that is 2.85 lakhs. So now we can compare that the fair value is 4 lakh and the book value is 2.85. So there is a fair value change of 1,15,000. There is a fair value increase which becomes pre to the extent of 1,15,000. And then what comes to the mind is the additional depreciations to be taken. And many people at times commit a mistake. They start taking the additional depreciation on 1,15,000. But you don't need to consider the depreciation on 115. You need to consider a question to yourself. What is the figure on which you took the depreciation and what is the figure on which you should have taken the depreciation? So we can say the company should have taken a depreciation on 4 lakh for the next 6 months, but they took it on 3 lakh for the next 6 months. So which means we need to consider additional depreciation on 1 lakh at the rate of 10% for a period of 6 months. We took depreciation on 3, but we should have taken a depreciation on 4. So on that additional increase of 1 lakh, you need a 6 months depreciation. And that I think works out at 5,000. So put it in the brackets because we need to make a reduction. So I think the fair value adjustments in terms of machinery is taken care. Wow. Now let's see further fair value adjustments. Continue with this analysis and let's see the further fair value adjustments as well. So we've got other fair value adjustments and they are also given in the additional information, the other fair value adjustments. So apart from the machinery, we're given land and building, inventories and trade payable. So there is increase in land and building. There is increase in the inventory. That's all again. And there is an increase in the trades payable. That's a loss. Increase in the assets is again an increase in the liability becomes a loss. Land and building increased by 2 lakhs. That's again pre. I'm not given a depreciation rate. So in the absence ignored. Inventories increased by 30,000. And trades payable is increasing by 20,000. That's a loss. So fair value adjustments done. The focus points number 2 is done. The third focus points now, that are we given any stock reserve information? No, we're not given any stock reserve information. So that's it. So with this, we are able to get the pre and the post acquisition profits as well. I don't think so there is anything different I have done in this question compared to the previous one. You would have seen, except for the presence of NCI, the calculations exactly similar. Okay, let's take the sum total of the pre column. This is 2 lakhs in the pre. Then it is another 60. Then it is another 72. And then it is another 1,15,000. And it is another 2 lakhs and another 30 minus 20. That comes to 657 is pre-acquisition in nature. Okay, similarly, let's see the post-acquisition columns. That is appearing at 72. And we've got minus the depreciation, that is 5. So the post-acquisition is 67. So that is the pre and the post-acquisition figures done. Now comes the step number 2B, where you need to focus in terms of net assets before and after dividend. As I said, if you are given the dividend information, it's a good exercise organizing two net assets in step number 2B. So we go on to the step number 2B, and in terms of the step number 2B, organize the net assets on the date of acquisition at a fair value in terms of two information. One is before dividends and one is after dividends. So that we calculate the goodwill NCI, we are very clear on that. Okay. So when you're going to consider before dividends, let's consider the sum total of the share capital plus pre. So what is the share capital of the subsidiary company? The share capital of the subsidiary company is 4 lakh and the pre-acquisition is 657. So we get the figures which is without reducing dividend. This figure was without taking a hit on the dividend. So automatically the dividends is not reduced so far. So 4 lakh plus 657, that comes to 10 lakh 57,000. Now, when you need to consider the figures which is after dividends, you take the share capital 4 lakh and you can reduce the dividend of 40,000. This becomes 617 because this 657 is without reducing 40. So if you reduce the dividend of 40, so that becomes 10 lakh 17. So this is the status of the net assets without and after reducing dividends. I hope, friends, the step number 2 is absolutely clear, I guess. Okay. So this is step number 2A and step number 2B. Then we go on to the step number 3, focus. We go on to the step number 3, and that is the calculation of the NCI. Now, when you're looking at the step number 3, couple of things coming to my mind. First of all, I am safe. There is no goodwill impairment. So I'm not really worried on the part that NCI is supposed to be at a fair value of PASNA. Goodwill is full or partial, because in this particular case, goodwill impairment is not given. So the implications of the goodwill being full or partial doesn't make a difference to me. So let's calculate the NCI on date of acquisition. And I think let's ask you this, friends. Tell me, are you going to consider after the net assets after, or are you going to consider the net assets before? Since we have done the calculations, let's quickly get your inputs. For NCI, you're going to consider after or before, and for goodwill, you're going to consider after or before. So first let's get NCI. So when you're going to consider NCI, what are you going to consider as a part of the net assets? Are we going to consider after dividends or are we going to consider before dividends? Get the focus. We need NCI on the balance sheet date. So if you need the information on the balance sheet date, we need to consider the figure which is after the dividends, because we need the status as on the balance sheet date. Okay, I didn't get any answers on that. Maybe it's just WIP still. But I guess you're clear with the fact that when you go to consider the NCI calculations, it is after dividend. Goodwill is going to be considered before dividends. Okay. So let's go to the NCI that is after the dividends, 10 lakh 17. Since we are considering PASNA, so 10 lakh 17,000 into 40%, because we're not given the status of the fair value. So we need to consider this on the basis of 1017. So out of 10 lakh 17, 40%, that is 406,800 is the net assets on acquisition date. And to this, we add the NCI share in post-acquisition profits. We need to add the NCI share in the post-acquisition profits. And that's available from the analysis itself. So if we look at the analysis, it is 67,000. So we can consider 67,000 into 40% belongs to the NCI. And that works out at 26,800. And we don't have any impairment of goodwill. Otherwise, we would have taken a goodwill impairment. But in this case, had there been goodwill impairment, we would not have taken a hit because NCI is taken at PASNA. So let's add this 26,800, 406,800. It comes to 433,600 is the NCI. Right. So that was step number 3, getting NCI. Now let's go to the step number 4. And step number 4, we have got goodwill or a bargain purchase gain. That is a capital reserve. Same calculations to be done, what you've done in terms of Ind AS 103. Let's see the investments in the balance sheet. The investment in the balance sheet is appearing at 8 lakhs. So we can consider the purchase consideration. That is 8 lakhs. And I think let's put the next question to you. Now, when you are going to consider NCI, are you going to consider net assets after or before dividend? Let's get that answer from you. Can I afford to pick this NCI for the purpose of goodwill calculation? Give me your answers on this, friends. And when I'm going to consider the net assets on the date of acquisition, will I be able to pick up this net assets, which is there in the previous part? You've got dividends in the question. So when you go to consider NCI, can I afford to pick it from step 3? When I'm going to consider the net assets, can I pick this from the step number 3? So do we need the net assets before or do we need the net assets after dividend? Let's, I think, now get your answer. And that's rightly given. It is going to be before. Wow. So we cannot pick this figure. We cannot pick this figure. We need the status which is before dividend. So we need to calculate the NCI based on net assets that is before dividends. We need to get the net assets out here also that is before dividends. So we need to get the net assets without dividend. So that is the key focus points. Okay. So for the NCI, we've done 2 net assets calculation. What is before dividend is 1057. So this becomes 10,57,000. And the NCI is 1057 into 40% is the NCI. So that focus needs to be very clear that when you're looking at NCI, we need status after. When you're looking at goodwill, we need the status before, and you know the logic why. The goodwill is what is there on acquisition date. The NCI is which is there on the balance sheet date. By the balance sheet date, dividends have already been paid. But on the acquisition date, the dividends are not yet paid. So the status of the calculations is pre-dividend. Okay. So if I calculate 1057 into 40%, it is 422,800. So let's get the total of this 8 lakh plus this is 1222,800 minus 1057. And that works out at 165,800 is the difference. That is good. Okay, that's great. So now with this step number 4, we are now going to go to step 5, focus other equity in the consolidated balance sheet. So let's go on to the step number 5 now, which is making the inputs in terms of other equity. So let's get the step number 5. We are trying to organize the other equity in the consolidated balance sheet. So as you organize the other equity in the consolidated balance sheet, let's make a small little extract of SOKI in order to get that information. So let me organize this in extract SOKI, a column for particulars, retained earnings, other components, and there is capital reserve, if any. Let's organize. So we've got retained earnings, we've got other components, and we've got capital reserve, if any. In this case, we don't have any capital reserve, but I've still created that on a safe side. So now we need to consider the 4 focus points. You need to consider the 4 focus points which I've given you. One is the post-acquisition earnings, one is the goodwill impairment, one is the dividend elimination, and one is the stock reserve, which is downstream. Okay, so let's consider the base holding company's own retained earnings and its other reserves appearing in the balance sheet. So if you go to the balance sheet of the parent company, the other reserves are appearing at 6 lakhs. And the retained earnings is appearing at 1,14,400. This is holding company's own profit picked up from the balance sheet of the parent company. Now, as we said, the 4 focus points, let's begin with number 1, holding share in subsidiary post-acquisition profits. And you can go back to the analysis of equity. The post-acquisition profits is 67,000. This is the post-acquisition profits. And out of this 67,000, 60% belongs to the parent company. So let's add this in RE. So 67,000 into 60%, that comes to 40,200. That is added to the retained earnings. The focus point number 2, there is any stock reserve? No. The focus point number 3, there is any goodwill impairment? No. And the only fourth focus point is we need to consider the elimination of the dividends received. The parent company, out of that 40,000, received a 60% dividend, that is 24,000, that needs to be eliminated from RE. So out of the 4 adjustments, only 2 adjustments are given. And there is no capital reserve, if any. We can now straightforward get the total. So 1,14,400 plus 24, minus 1,14,400 plus 40,200 minus 24. This comes to 130,600. And this is 60,000. And this is nil. So let's get the total as well. This is 136,600 is the other equity in terms of totality. Okay, so far so good. So now with this inputs, we can go on further. Okay, so this is done. Now let me take it further and let's go to the, okay, so this was 6 lakh, sorry. I think this is 6 lakh, my mistake. The total goes incorrect. So this will be 6 lakh plus this 730,600 is the total. That's not 60, that is 6 lakh. So the total works out at 7,30,600 in the balance sheet. Okay, so now we are in a position to make a consolidated balance sheet as well. So let's make now the step number 6, consolidated balance sheet. So I think with this question, you would have got a little more confidence in terms of things. If you made your revisions on the previous class, then I think this would not have sounded very technical indeed. Though I guess I'm trying to maintain a little more speed in terms of doing this question. I hope that is fine. Because considering that it is quite similar except for the NCI presence, I think the calculations are absolutely similar. Okay, so now let's begin with the consolidated balance sheet, starting with the asset side. And we're going to start with the non-current assets. So let's begin with the balance sheet on asset side. So we're given first of all PPE, which comprises of land and building, plant and machinery. So as far as land and building is concerned, the parent company is 3 lakh, the subsidiary is 3.6 lakh, and least we forget, you need to consider the fair value adjustments and additional depreciation. So I think for land and building, it was an increase of 2 lakhs with no additional depreciation. So that works out at 8.6 lakhs. The next in the balance sheet is plant and machinery, and that is 4.8 lakhs for the parent, and it is 2.7 lakh for the subsidiary. And then you need to consider the fair value adjustments. Plant and machinery, I think increase was 1,15,000 and additional depreciation, I think was 5,000. So fair value change and additional depreciation. So that is 4,80,000 plus 2,70,000 plus 1,15,000 minus 5. That's also 8.6 lakh itself. And next we're given investments that would not appear in the balance sheet. And then we're given, least we forget, goodwill. So goodwill computed in earlier step, 165,800 is goodwill. Then let's pick up the current assets as well. Current assets, we are given inventory. So inventory we are given for the parent company, and that is 2,40,000. And inventory for the subsidiary is 72,800. And the fair value adjustments, if any. And inventories increased by 30,000. That is the fair value change. And he's already said that the inventory is unsold. So we add the increase 342,800. No stock reserve informations are given, so no adjustments. Next, we are given trade receivables and then cash. So in terms of the trade receivables, the trade receivable is 1,19,600 for the parent, and it is 80,000 for the subsidiary. So 1,19,600 plus 80, and there is no fair value adjustments for a trade receivable, no intercompany owings. So 199,600 becomes the trade receivable. And then there is a cash which is 29,000 and it is 16,000. So the total becomes 45,000. So this will give us the total of the asset side of the balance sheet. So 8,60,000 plus another 860, 165,800, 342,800, 199,600 and 45. I think it's coming to 24,73,200. 24,73,200 is the total of the balance sheet. Wow. Now I think let's go on to the liability side as well. The asset side is done. Now let's go to the liability side, equity and liabilities. So in terms of equity and liabilities, let's begin with the equity. So we've got equity share capital only for the parent company. We're not considering the share capital of the subsidiary. So the equity share capital of the parent company is 10 lakh. The other equity which you can consider from the workings we have done earlier. So that is 730,600. That is 730,600 in step number 5. And least we forget, we need to consider NCI as well, because NCI would also be a part of the equity in the balance sheet of the company. So as far as NCI is concerned, 433,600 is NCI. So this is as far as other equity is concerned. Then we go on to the liabilities, non-current liability. I guess we're not given any non-current liabilities and just the current liabilities are given. So we are given the bank OD as well as a trades payable. The bank OD is appearing at 1,60,000, and as far as the trades payable is concerned, parent company is 94,200, subsidiary is 34,800, and there is a fair value adjustments as well. Trade payables increased by 20,000. That is the fair value change. So 94,200 plus 34,800 plus another 20, that makes it 149. So hopefully now this balance sheet should agree. So 10 lakh plus 730,600, 433,600, 160, 149. Wow, this is 24,73,200 is the total of the balance sheet. Wow. Right, friends. So that takes care of the consolidated balance sheet as well. All these 6 steps are done. Now, before we go further, I need to get your comfort zones on this, because we've done questions on all the 4 cases with you, whether it is a consolidation on balance sheet date, acquisition date with without NCI, or it's a consolidation later with without NCI. So give me, friends, your comfort zones on a scale of 10 on the consolidation process. Mind maps are done, the basic questions are done. Depending upon your comfort zone, I'm going to select my next question. Either something similar or a little more drastic in nature. I want to do something drastic. So I think let's get your comfort zones before we take it further. Okay, Tanisha, you said, sir, when in the exams we're going to present this answer in a step-by-step manner, like how you do, isn't it, sir? Of course you can. Except that, you know what you can do when you're presenting these steps, you can call them as working notes number 1, 2, 3, 4, 5, 6. The step number 6, which I'm doing, is a main solution presenting the consolidated balance sheet. So the initial 6 steps, you can call it as working note number 1. Even if you call them as a step by step, I don't think so there is a problem. But I think as a better presentation, maybe you can call them as working note number 1 to 5, organize the working notes, and then step number 6 becomes a main solution. Okay, so I think I got the inputs 8 and 9 /9 out of 10. That's great. So we got 2 scores so far. I thought I was getting more inputs from you. Okay, so I think that seems to be quite a comfort zone. I'm going to take that as a representative of the scores and let's increase the level. I think we can, right? Okay, so let me now take you to one of the examination questions, which is slightly different from this particular question. It came in January 21 examination. Okay, we got another score 9 as well. That's wonderful indeed. Okay, so I'm carrying a question with me. And let's do that question with you, something different. It contains a little more inputs as well. So I have taken a question which is January 21. Yes, I think this is the question. Correct. So I think let's show you this particular question. This is question number 19, which I've taken, is supposed to be January 21 examination question. Level is going to be slightly more than what we have done so far. So let's read it carefully. Let's analyze. You are going to do this question the way I've given you the step-by-step inputs, but there are 1 or 2 more additional inputs in this question, which I've theoretically discussed, but we're going to do them in this question as well. Let's first read the inputs. This was one of the good questions which came in January 21 exams, 15 marks. I guess let's read. It says on 1st April 17, A acquired 80% share capital of S. I can already see that the balance sheet which is given below is 31st March 19. Well, I guess generally in the exams, you're going to get a case 4, which is making a balance sheet at a later date, and that also is going to be with NCI. So very clearly, the date of acquisition is April 17 and the balance sheet date is March 19. So I can undoubtedly say it is a case number 4. We're making a consolidation later with an NCI. Then he says on the acquisition date, the share capital and the reserves of the subsidiary is given. This is one input which encourages people. Sir, since the share capital and the reserve on the acquisition date is given, the pre-acquisition situation is already given. The net assets on the date of acquisition is already given. And the tendency is that you start thinking that I don't need the analysis. Please don't do that mistake. Even though I am given the status of the share capital and the reserves on the acquisition date, it nowhere encourages me not to do the analysis, because as a part of the analysis, you're also going to consider the fair value adjustments. So what if I just take this figure and make the adjustments to fair value? You're going to miss out on additional depreciations for the post-acquisition, etc. So don't take the risk of not doing the analysis simply because he's given you the position on the acquisition date. We're still going to do the analysis. Then he says A paid an initial cash consideration and additionally A issued 2 lakh equity shares with a face value, a nominal value of 1 and a current value, market value of 1.8. So the consideration was initially paid in cash as well as shares. It was also agreed that A would pay a further sum of 5 lakh after 3 years. When it says after 3 years, automatically what comes to the mind is it is DC. It is a deferred consideration. And then it says A Limited's cost of capital is 10% because we need to consider the DC as a part of the PC at a fair value, what you've done in Index 103. Okay, then it says the appropriate discounting factors are given. The shares and the deferred consideration is not yet been recorded by A. Wow. He says in the balance sheet of A, he has not taken care of the shares issued to the shareholders of B. He's not taken care of the DC, which means investment in the balance sheet is not the entire PC. So when you look at the balance sheet, we are given the investment, but this is not including the shares given to the shareholder. This is not including the DC. So this is, you can say, a PC which is only cash component. So you cannot take this as a base. Now, my advice is, since in this particular case, the parent company is not yet incorporated, he is not yet incorporated the shares issued to the shareholders and the DC. I would say that before you start the question, please make an extract balance sheet. It is a case of omission, and if it is a case of omission, it would be more logical that before you proceed with the question, make an extract balance sheet, incorporate the missing information which is not yet recorded and make an extract balance sheet and then proceed. That's what I'm going to do. So that doesn't become a part of the consolidation adjustments, but it's a case of omissions. Then it says further information on the date of acquisition, the fair value of S exceeded the book value and the plant has got a remaining life for 5 years of fair value adjustments. Goodwill is being impaired by 258. If goodwill is impaired, we need to be careful. Is it partial or is it full goodwill? So that accordingly, the impairment hit can be taken to the parent or parent plus NCI. So we yet to see what is the NCI valued at. So we'll take a call on that. And then further, we are given the inputs. So further, we are given in point number 3. It says A values the NCI using a fair value method, which means the goodwill is supposed to be full. And if the goodwill is supposed to be full, you need to consider the impairment of goodwill to be segregated both towards parent and NCI. Okay. And then it says at the acquisition date, the fair value of 20% NCI is already given. You are required to make a consolidated balance sheet on March 19. Notes to accounts not required. So that is a good question. I think at least we've got 2 more inputs in the question. One is the concept of goodwill impairment. Being a full goodwill, you need to take the hit to the NCI and the parent, and the omission in terms of the DC and the shares issued. So as I said, the very first focus point would be to make an extract balance sheet because the parent has not recorded the shares given and has not recorded the DC. Let's take care of that. So let's begin the journey with, first of all, the extract balance sheets in hand. I would always advise that if there are any kind of omissions which are done in the consolidation questions, don't proceed with the 6 steps, but before the 6 steps, make an extract balance sheet in this case. So now let's visualize. So if I'm looking at the answer, I think first I need to understand that what kind of entries would have been done on 1st April 17 and what kind of entries will be done subsequently. And that was the reason when I did Index 103 with you. If you remember, I gave you a sequence of entries which are done on acquisition date and the entries which are done post the acquisition date. So let's do one thing. We're going to create a simple little chart before we make an extract balance sheet. Let's have a look at the entries to begin with. So I want to see the entries which would have been done on the date of acquisition and the entries which would have been done in the post-acquisition period. In this particular case, we are very clearly given in the question, the date of acquisition is 1st April 17. So date of acquisition is 1st April 17 and the post-acquisition is starting from 1st April 17 and is ending on March 19. It's a period of 2 years. It's a period of 2 years. So now let's go to the first part. It says A issued 2 lakh equity shares with a face value 1 at a current market value 1.8. So we can say the entry which should have been done would have been investment debit, equity share capital was given a credit, and the security premium would have been given a credit. So there was an omission as far as recording of the shares given were concerned. So we're going to put the entry investment debit and share capital with the face value and the premium with the premium. So he's given us the status that 2 lakh shares with a fair value 1.8. And we can say the equity share capital with a face value 1 and the remaining 0.8 becomes a premium. Now, we also need to visualize that if this entry was done on the date of acquisition, would there have been any subsequent entries for the year ended 18 and 19? No. This would not have resulted in any entries being done at the end of 18 or any entries being done at the end of 19. No entries would have been done subsequently. Okay. The next is the deferred consideration. A agreed to also pay a further sum of 5 lakh after 3 years. Now, this money is payable after 3 years. So what we would have done, we would have taken the fair value, the present value of the DC. So we can say another entry we would have done is investment debit. And the deferred consideration would have been given a credit, which is equal to the fair value of this investment. So we can say 5 lakh is what would have been given and the present value factor is 0.75. This 5 lakh would have been given 3 years later. So let's take the present value of this. So 5 lakh into 0.75. And that works out at 3.75 lakhs. That is investment debit and the deferred consideration is given a credit. Now the question arises, would this lead to any kind of entry subsequently? I want you to remind me, friends. If there is a DC, what is the accounting effect which is taken care in the post-acquisition period? Tell me. That single little word which is important in order to consider this. And Shruti, sir, today's 30 minutes, very useful, sir. It'll help us in the long term. Usually student only has to prepare it after all the adjustments. Thank you, helped us to do earlier. Thank you. Most welcome, Shruti. Thank you so much indeed. So my question now is in terms of the DC, what are you going to do in the post-acquisition period? I gave you a golden rule in terms of Ind AS as well. Whenever you consider the present value, you need to consider something which we call commonly as. I want to hear that term today from you. So what is the accounting entries to be done on March 18 and March 19, considering that you've taken DC based on the present value concept? So give me, friends, what are you going to do in the next 2 years considering this part? Let's get your answers. In the meantime, let me get ready to make my extract balance sheet as well. So based on this, I'm going to make the extract balance sheet of the parent company. Because on this basis, we need to get the March 19 balance sheet as well. I still didn't get any answers on that. Oh my God. Remember in Ind AS 103, I gave you DC leads to UOD. That is the concept of unwinding of discount. Oh my God. I had given that in terms of chart as well, that when you consider the present value, it leads to the concept of unwinding of discount, which is nothing but compounding. I give you that whenever in terms of Ind AS, you're going to consider present value, you're going to correspondingly consider the concept of the unwinding, the finance charge as well. Okay, so we got the answer now, UOD. That's right. So you're going to put the entry finance charge gets a debit and DC gets a credit. And the same entry will be done in March 19 as well. Finance charge gets a debit and deferred consideration gets a credit. Now we need to work out the figures in terms of the interest as well. Discounting was done at the rate of 10%, so you need to compound at the rate of 10%. So we can say on 3,75,000, 10% would mean 37,500. And in the next year, remember, you need to consider the unwinding on the cumulative amount. So the figure on which interest will be taken is 375 plus another 37,500, and you would take a 10% unwinding on the same. So 10% would come to 41,250 is the finance charge for the next year, March 19 as well. Okay, so trust me, what I'm doing right now is not exactly a consolidation. It is the impact of Ind AS 103, which has been missed out, and we're putting the journal entries for that purpose. So we're putting the journal entries which the company should have passed on acquisition date and in the post-acquisition period. So this is the UOD, unwinding of discount. Now, with this particular status in hand, we can now make an extract balance sheet of the parent company that is on March 19. So we need to be very sure now which particular heads of items will get affected in the balance sheet of the company. So we can see that the equity share capital would change, security premium will come, investment figures will change, DC will change, and the finance charge will change the figure of retained earnings in the balance sheet as well. So let's do one thing. Let's, I think, first of all, pick up the asset side, and then we're going to pick up the equity and liability side, and we'll see whatever changes are required. So let's go one by one on these inputs. On the asset side, we just need to change the investment. So let's consider the investments appearing in the balance sheet. I guess the investment is appearing in the balance sheet at 1,000, which is in terms of thousands. That is basically 10 lakhs. So investment is appearing in the balance sheet at 10 lakh. And to this, you need to add number one, 3.6 lakh. This is one component. And you need to add 3.75 as well. So the extract balance sheet, the investments will undergo a change. So I'm just putting a tick so that everything gets incorporated in the extract. So 13.6, 3.75, that is 17.35 lakhs is the investment. Okay, then I guess we can consider the equity share capital. That's the second change. The equity share capital is appearing in the balance sheet of the parent company at 20 lakhs. And along with this, we'll add the face value that is 2 lakh. So the share capital of the parent company becomes 22 lakhs in the balance sheet of the company. Next, we also have the inputs in terms of other equity. So in the balance sheet, we are given retained earnings. So in terms of other equity, there is retained earnings. Let's also consider security premium as well. So security premium works out at 1.6 lakhs. That was not there earlier. And in terms of the retained earnings, you need to take a hit of this finance charge on the retained earnings as well. So retained earnings is appearing in the balance sheet at 14 lakhs. So from this 14 lakhs, you're going to reduce the finance charge, and let's get the figure. So from 14 lakhs, you reduce 37,500. You reduce 41,250. That comes to 1321,250. So the finance charge gets reduced from the retained earnings. One is 37,500 and one is 41,250. So I guess we have taken care of the finance charge as well. And I think the only input which is left over is the DC. So you just need to change the figure of DC. It was not in the balance sheet. So let's show the extract balance sheet. The deferred consideration is also going to be reflected. So your deferred consideration is 3,75,000 plus 37,500 plus 41,250. It is appearing in the balance sheet at 453,750. This is DC. I guess all the entries are now incorporated. Investment stands changed. Share capital premium stands changed. DC stands changed. And the finance charge taken a hit on the retained earning. So this was an omission on the part of the parent company, which I believe is more appropriate before you start. Because I think if you've handled this particular part, there were two major elements in the question. One is the omission part and one is the goodwill impairment. Goodwill impairment, of course, we'll take care in the 6 steps, but at least this part is taken care. All right, I believe, friends, we are now absolutely clear with this particular part. So let me just quickly consolidate the inputs in terms of this adjustment. Now, I would advise many a times, what the examiner would do when he gives you the status of the investment in the balance sheet of the parent company, he might give you certain part of PC which is omitted and not yet recorded. And typically, he's going to test your knowledge in terms of Ind AS 103. That if there is a deferred consideration, have you remembered to consider unwinding of discount? If there is a contingent consideration, depending it is a financial liability or it is an equity instrument, do you remember to consider the fair value changes or not? If you remember, even in terms of the contingent consideration, if it is a financial liability, when the amount is paid in cash or variable shares, you need to consider a fair value changes subsequently. And if it is supposed to be fixed number of shares, it doesn't need changes. So in this case, what he did, he said, I've omitted to record the shares given to the shareholder. So it is more appropriate you put the entry and see what entry would have been done for the issue of shares, and that would not have led to any kind of changes to be recorded in the post acquisition period. Then there was a deferred consideration which was not yet captured. So you put that entry for the deferred consideration at the present value of what you're going to pay 3 years later. And since you apply the concept of present value, you do the unwinding of discount. Make your extract balance sheets, incorporate the figures of investments and the share capital, the premium, the DC, everything into account, get your extract balance sheet. Now remember, when you go to do the consolidation process, you need to remember to look at this extract balance sheet and the balance sheet, remaining balance sheet of the parent and subsidiary for the step number 6. Because what happens when you go to the step number 6 on consolidation, you'll start looking into the balance sheet given in the question. But you need to incorporate this extract balance sheet there and then. Okay. So now we need to start a journey in terms of the 6 steps. But I think now, before we go to the 6 steps, let's, I think, give you a break because this is now going to be in a flow. So let me see if any questions coming and your mind so far. Okay, nothing so far indeed. So I think it's good. It's, I think, almost time to give you a break now. So almost around 8:41, 42. So we'll take a 10, 12 minutes break and we commence back with the remaining steps on this. Enjoy your break, relax your minds, get ready for the 6 step models. Friends, so I hope you relax your mind. And I think now let's take the journey forward on this particular question. So we are now going to apply our 6-step model in terms of solving this question out. And of course, considering the exact balance sheet as well. Okay, so now let's begin with the step number 1. After the exact balance sheet, let's come to the regular steps. Step number 1, where you need to consider the date of acquisition and the percentage. So let's see what is the date of acquisition and what is the percentage. And in this particular question, I would like to pinpoint as well, the post-acquisition period is comprising a period of 2 years because the date of acquisition is supposed to be 1st April 17 and you're making the balance sheet on March 19. And in fact, this was almost the first time, when the post-acquisition period was comprising of 2 years. And that can be very interesting to watch because sometimes, people always tend to believe that a post-acquisition period is always a period of 1 year or less than 1 year. Well, you will make a consolidated balance sheet year by year, so post-acquisition period can run in as many years as possible. So the date of acquisition is 1st April 17, and the percentage in this case is given. He's acquired 80% of the share capital. Then we go on to the step number 2, and we know that we need the step 2 in 2 parts. It is a case where we are making a balance sheet at a later date. So I need the analysis of other equity, and let's keep the focus points clear. So we need the analysis of the other equity. Let's first create a chart, and with the help of which we'll do the analysis, a column for particulars, a pre and a post acquisition column as well. So let's consider first of all the balance sheet focus. First, let's put this. This is pre-acquisition and this is post-acquisition. In terms of pre-acquisition, this is pre-1st April 17, and anything earned from the date of acquisition 1st April 17 till March 19 is post-acquisition. So you've got a period of 2 years as a part of the post-acquisition. Get the focus points clear again. We're going to concentrate first of all on the balance sheet of the subsidiary and look at the other equity appearing in the balance sheet of the subsidiary. So let's go to the balance sheet of the subsidiary in the question, and in the balance sheet we can see that I am given the status of retained earnings only. In this case, I'm not given anything apart from the retained earnings. So let's pick up the retained earnings. Remember first to create a time scale and get the analysis. So this is going to be 1st April 17 and this is March 19. And the beginning of the year itself is the date of acquisition also. So let's see what is the retained earnings given in the question. The retained earnings in the balance sheet of the subsidiary is appearing at 3 lakh. So this is the status of the retained earnings at the end of the year. Now, if you go to the additional information, it is very clearly given the reserves on the acquisition date is appearing at 1,25,000. So the retained earnings at the acquisition date was 1.25. And in this particular case, I guess if you notice, we are not given any dividends information. So I think that calculation of the net assets before and after dividend all is not required, because if dividend information is not there, we are safe. But we can definitely say that this increase of 1.75 lakhs is supposed to be an earning in the post-acquisition period. So 1.25 lakh is the balance on acquisition date pre, and the increase of 1.75 lakhs is supposed to be post in nature. So the focus number 1 is done. The analysis of the other equity of the subsidiary is done. Focus number 2, and that is we're looking at fair value adjustments, if any. So on the fair value adjustments, we go to the additional information, and there is only one fair value adjustments in point number 1. On the date of acquisition, the fair value of the subsidiary exceeded the book value by 2 lakh, he's already given you what is the increase in the fair value. So we given the increase in the fair value compared to the book value for the plant is 2 lakhs. So there is increase in the value of plant to the extent of 2 lakh, and this will also lead to additional depreciation being taken in the post-acquisition period. And it says the remaining life of the plant is 5 years, and when you consider a depreciation, we need to consider it prospectively. So remember, this 2 lakh will be spread over 5 years, and most importantly, you need to consider a depreciation for the post-acquisition period, which is 2 years. Because we've already pinpointed that from April 17 to March 19, you've got a 2 years post-acquisition. So 40,000 is the annual depreciation. So for 2 years, it comes to 80,000. Okay, so that's the only fair value adjustments given. And then the focus number 3, stock reserve, it's not given in the question. So I think that's it. There is nothing else which is defined. So we are done with the analysis of other equity. I think naturally it becomes easy because the focus of the examiner is testing your knowledge on the extract balance sheet. So they've diluted the remaining part of the question: no dividends, no other fair value adjustments, and no stock reserve either. Okay, so this becomes, I think, 3.25 lakhs. This is 3.25 lakhs, and the post acquisition is to the extent of 95,000. So now we can organize the net assets on the date of acquisition at a fair value, which is equal to the equity share capital plus the pre-acquisition profit. Indirectly, we're doing the step number 2B. See how much the life becomes simple. Trust me, if you're going on a step by step and your focus points are very clear, what is to be done at each stage, nothing can stop you from going wrong. Okay, so let's see the net assets. And as I said, no dividends are given. So I'm not concerned with the fact that whether there is net assets before and after. We just need a single figure. Now the share capital of the subsidiary company is appearing in the balance sheet at 5 lakh and the pre-acquisition is 3.25 lakh. So we can say the net assets on the date of acquisition is 8.25 lakhs. So far, so good. Nothing complicated in terms of step 2A and step 2B. Okay, now let's go to the step number 3. And now we are concerned because there is a goodwill impairment which is given. So when you go to consider the NCI, the focus is very clear that the NCI is at a fair value. And immediately what comes to the mind is, if the NCI is at a fair value, you know it's a full goodwill and the impairment is borne by the parent and the NCI both. So the moment NCI is at fair value, you know we're going to get the concept of full goodwill in this particular case. So I think let's calculate the NCI now. So the NCI on the date of acquisition is already given in the question. And it says in the point number 3 that value of the NCI on the date of acquisition is 3 lakh 80. This is already given in the question. And to this, we just need to add the NCI share in post-acquisition profits. The NCI share in post-acquisition profits. And that's already available in the analysis. So we're going to get that information from the analysis. 95,000 is the post-acquisition earnings, and out of that 20% belongs to the NCI, and that works out at 19,000. And I think least we forget, this is 399, but least we forget, we also need to consider the goodwill impairment as well. Since the NCI is taken at a fair value and the goodwill is full in amount, you also need to consider the impact of goodwill impairment. And the goodwill impairment amount is already given in the question in point number 2. The goodwill is impaired by 258, but you need to consider only the NCI share in this particular goodwill. So 20% of this, so 258 into 20%, 51,600 is the goodwill impairment. And that's going to give me the NCI. So this works out at 399 minus 51,600, 347,400 is the NCI. Pretty simple and pretty straight indeed. Okay, then we go to the step number 4, and in terms of the step number 4, we need goodwill. In terms of step number 4, we need the goodwill, and I know for sure there is goodwill, because if there is a goodwill impairment given, there cannot be a bargain purchase gain. So I think the focus is very clear. We're undoubtedly going to get a goodwill. So we consider the purchase consideration, and now you need to be careful that this purchase consideration is going to be picked up from the extract balance sheet and not the balance sheet given in the question. We've already done our workings in terms of this PC, so you could give the reference to the examiner as well that this is going to be picked up from the extract balance sheet. So let's go back to the extract balance sheet. The investments is appearing at 17,35,000. So that is the purchase consideration. And then you add the NCI, and something stops me. And what is that? I should not take this NCI from step number 3, but. In this case, number 1, there is no dividends. And number 2, the NCI is at a fair value, which means that even if there was a dividend, can I comfortably pick up this figure or not? Yes, I can. It is only if the NCI is at PASNA, I would not pick up the figure from the step number 3. But if the NCI is at a fair value, whether there is a dividends or there is no dividend, doesn't make a difference. Then you can simply pick up the figure from the step number 3, that is 3,80,000. That is on the date of acquisition. And we're going to compare this with the net assets on the date of acquisition. So 1,735 plus 3,80,000, that works out at 21,15,000. And net assets on the date of acquisition is already there in step 2B, and that is 8,25,000. So that works out at 8,25,000. So we're going to get the amount of goodwill. That works out at 12,90,000 is the goodwill. And least we forget, we need to consider goodwill impairment. The parent company share or the entire goodwill. In this case, it doesn't make a difference whether it is partial or full goodwill. You need a revised value of goodwill. So in any case, I'm not concerned at this stage. It is only when in step number 5, when you go to consider goodwill impairment, you'll take parent company share. In this case, it'll always be the full impairment amount. Whatever is the entire impairment of goodwill, you'll make an entire reduction of that. That is 258. So remember, in NCI, the focus points. In terms of NCI, goodwill impairment is reduced. Rather, let me do one thing. Let me just calculate and make a note for you, which will be helpful later. So this is 1032 is the revised value of goodwill post the impairment. So, these small little issues at times, disturbs us before the exams. And I think if you make your mind maps very clear, it's going to be very helpful. So let's do one thing. Let's, I think, give you a little focus point, because this can be disturbing at times. And let me tell you that when you are going to consider the goodwill impairment, what are the key considerations? So when you go to look at the impairment of goodwill, let us see the key considerations under various steps. Let us see the key considerations which you need to keep under various steps, so that your mind is very clear. Okay, this is what I need to do under each step. So the focus point number 1 is when you calculate step number 3, that is NCI. One is when you calculate in step number 4, goodwill. And one is when you go to the step number 5 and you prepare the other equity for consolidated balance sheet. So these are the 3 focus points. And I think since you don't go wrong, let me, give you the focus points, what you need to do under each stage. So in this particular case, I can put it like this. if your NCI is at a fair value or the NCI is at PASNA. If the NCI is at a fair value, you will reduce the impairment loss of NCI. You will reduce the goodwill impairment loss to the extent it belongs to the NCI. If it is a case of PASNA, there will be no reduction because goodwill is appearing as partial only to the parent. So no goodwill hit will be taken to the NCI. In terms of goodwill, whether the NCI is taken at a fair value or whether the NCI is taken at a PASNA, it does not make a difference. Under both the cases, you need to reduce the entire impairment loss. I'm not worried on this part, whether it is a partial or a full goodwill, because you just need to reduce the goodwill impairment figure in entirety. And in terms of step number 5, if your NCI is taken at a fair value or if your NCI is taken at a PASNA, proportionate share. So you need to be very clear that goodwill impairment will lead a mark in terms of which places, because that is the mind mapping which is to be thought of in your minds. If the NCI is at a fair value, then we will reduce the impairment loss of holding company only. We will reduce the share of the holding company only. But if the NCI is at PASNA, we'll reduce the entire. We will reduce the entire impairment loss in this case because everything belongs to the parent. So get it very clear that in terms of NCI, it takes a hit when NCI is at fair value. Goodwill, the impairment is fully recorded irrespective, and in the balance sheet or the equity, if NCI fair value, parent share reduced, otherwise reduce the full goodwill value impairment itself. Right? I think this is a very, very important input. So let me put it as very, very important. This will help you a lot later. All the mind maps which I create for you, trust me, you're going to be of very helpful use to you before the examinations, because when your mind starts disturbing in terms of what is to be done, which place, where, what, when, this is going to be quite helpful indeed. Okay, so I guess let's now take it further. So we're done with this in terms of step number 4. I think step number 4 is done. All right, now let's go to the step number 5 and let's get the figures in terms of other equity in the consolidated balance sheet. So let's go to the step number 5. In terms of step number 5, we are trying to calculate the other equity in the consolidated balance sheet. And again, we're going to make an extract of SOKI to get the figures correct. So let me press, because we need to get this figure from the extract balance sheet in this particular case. So let's go to the extract balance sheet. And in terms of the extract balance sheet, we go back. So my extract balance sheet reflects me that my retained earnings is 1321,250. 1321,250. So this is 1321,250. There is no other components of equity. So you got to first of all pick up the information from the extract balance sheet to be on a very safe side. Thereafter, we need to get the focus points, holding share in subsidiary, post-acquisition earnings. And this is available from the analysis. And in terms of the step number 2A, in the analysis, the post-acquisition is 95,000. So we will consider out of this 95,000, 80% belongs to the parent company, 20% we've taken in NCI. So 95,000 into 80% is 76,000. The focus point number 2, we've got goodwill impairment loss. And since the NCI is at a fair value, you need to consider the goodwill impairment parent company. So 258 is the goodwill impairment, and out of this 80% belongs to the parent company. So 258, 80% would be 206,400. Okay, let's see a few more items are there in terms of the focus points. So post acquisition done, and goodwill impairment done. Any stock reserve? No. Any element of dividends? No. So I think there is nothing else which is given as far as other equity is concerned. So this is done. So this is 1,60,000 and this is 0. And this works out at 1321,250 plus 76,000 minus 206,400. It comes to 1190,850. So let's get the sum total of this. So the total other equity is 1350,1350,850. That is the other equity. Okay, I hope friends you're finding this absolutely convenient to do. I don't think so there would be much concerns in terms of this particular question. I guess it is going smooth indeed. Okay, and this is done. Now with this inputs further, let's take it further. So this is done. Now let's go to the step number 6, sorry. We're going to go to the consolidated with the step-by-step methodology where you get your focus points clear, what is done at each stage. You will not go wrong because you know what is the focus points to be kept in mind. Trust me, do every question what we have done today and do some extra practice questions as well. Once you're going to do them in a chronological order with a step-and-step approach, you will feel very, very confident, trust me. Okay, so let's now make the consolidated balance sheet as well. Starting with the asset side of the balance sheet, and please consider the extract balance sheet also into account. So your focus has to be on the extract balance sheet as well. So first of all, we've given the non-current assets, that is PPE. So the parent company has got PPE to the extent of 55 lakhs and the subsidiary company has got PPE to the extent of 15 lakhs. Then there is a fair value adjustments. I need to go back. That was, I think, 2 lakhs and 80,000 additional depreciation. So 2 lakh is the fair value adjustments and 80,000 is the additional depreciation. So we get the figure of PPE. So 55 plus 15, 70 plus another 2 minus 80, that works out at 71.2 lakhs. Okay, the next item is the investments that would not appear in the balance sheet, but least we forget, let's consider the goodwill. That is post impairment. So goodwill is 1032. So goodwill comes to 10.32 lakhs is the goodwill. Then we are given on the current assets side, and on the current assets, we are given inventory, receivables, and cash. So we've got inventory, we've got receivables, and we've got cash. So inventory is given 5.5 lakhs and 1 lakh, 5.5 and 1 lakh, and there is no fair value adjustments. There is no stock reserve either. So that remains at 5.5 plus 1, that is 6.5 lakhs. Then in terms of receivables, it is 4 plus 2, no intercompany owings, nothing. So that appears at 6 lakhs. Then there is a cash which is 2 lakh plus 50. So this is 2 lakh plus another 50,000, that makes it 2.5 lakh. Okay, I think let me just go back to the extract balance sheet to see if there is anything else on the asset side which needs adjustments. Okay, I think investment stands eliminated. That's done. We'll take care of the equity, share capital, other equity, etc. So there is nothing further. So I think with this, we can get the total of the asset side of the balance sheet. So 71 lakh 20 plus 10 lakh 32 plus 6 lakh 50 plus another 8 lakh 50. That works out at 96 lakh 52,000 is the total of the balance sheet. Okay, so this takes care of the asset side of the balance sheet. 96 lakh 52,000 is the total. Now let's go to the equity and the liability side as well. So let's go to the equity and the liability side now. So in terms of equity and the liability side, let's first consider the concept of equity share capital, extract balance sheet. Again, the moment you're going to pick up this figure, you need to go to the extract balance sheet in this particular case. And I think it was 22 lakhs, if I rightly remember. So this was 22 lakhs. Then other equity, what you picked up from the earlier steps. My other equity is in step 5. That is 1350, 850. This is 1350, 850 is other equity. Least we forget, let's consider the NCI as well. And the NCI is 347, 400. This is 347, 400 is the NCI. Okay, I think the equity component is done. Now let's go further. After the equity component, no non-current liabilities are given. Oh, no, we are given the non-current liabilities as well. So let's consider the non-current liabilities, and there is, a DC, and we also need to decide, is the DC current or non-current in nature? The deferred consideration is going to be paid in another 1 year's time, because it was due to be paid 3 years later. 2 years have already elapsed, so there is another 1 year within which it is payable. It becomes current in nature. So non-current liabilities, we can just add the parent company 30 plus the subsidiary company is another 4 lakh. That makes it 34 lakhs. And then we are given the current liabilities as well. The parent company is 12.5 lakhs and the subsidiary company is to the extent of 6.5 lakhs. And I think let's also add the deferred consideration. So we need to go back to the extract balance sheet for DC. And I think the deferred consideration is 453,750. 453,750. That is the DC. Okay, finally, I think that gives us the current liabilities as well. And let's see if this is agreed. So 12 lakh 50 plus another 6 lakh 50, 453,750. That is 23 lakh 53,750. So let's see the total of the balance sheet. So 22 lakh 1350, 850, 347, 400, 34 lakhs. That works out at 96 lakh 52,000 is the total, and I think that is agreed. Wow. So we've been able to manage the question, and managing the speed of the question is also important, that you should be decently able to do this question in almost like 40 to 45 minutes at the max. Generally around 40 minutes on an average is a good pace to go. And I think with the explanations, almost we've been able to manage this in around 45 minutes time. If you remember, when I started doing the questions with explanations, it was taking almost 1 hour, and I think it's now got reduced to 45 minutes. And once you go to practice well, you should be able to bring your speed almost to the tune of 35 to 40 minutes doing such a question. Okay, so this is done. Let's see if any questions coming in. I don't think so. Anything coming so far. Great. So I believe, friends, now you are feeling much more confident with the inputs to be done in all these 6-step models, especially, once you now know what are the focus points under each step. I think it should not be causing much concern. Now, I think we should go to the income statement. Okay, I hope everybody is pretty comfortable with the concept of consolidated balance sheet. I need to give you a chain holding as well, but I'll be doing a question on chain holding tomorrow. I want to first take you to the question on a consolidated income statement. Chain holdings, I'm going to concentrate tomorrow. So now let's give you some insights in terms of consolidated income statement. Okay, now hear me very carefully as we discuss the concept in terms of consolidated income statement. It is very easy. It is very easy. I'll make you a walkthrough on one of the questions which is given in the study material on a consolidated income statement. Now let's first understand the concept. When you're going to make a consolidated income statement, When you're going to make a consolidated income statement, let us understand what you need to do conceptually so that once we do a practical illustration, you're very clear on things. Well, we know this very well that the income statement comprises of two sections. One is the P&L and one is the OCI. So in this particular case, what do you need to do? When you going to make a consolidated income statement, I would say number one, you've got a profit and loss section where, for example, you consider the sales and you consider, let us say, the expenses, and you're going to get the profits. Now, what are the inputs you need to, consider in this particular case? Number one, you would add up the aggregate the sales of holding and subsidiary and even the expenses of holding and subsidiary. But one thing you need to be careful on, and that is from this, you need to reduce any kind of intercompany sales which they're made with each other. So what I'm going to do in this particular case, when you consider the sales of the parent and subsidiary, but if there is any intercompany sale transactions with each other, eliminate the same. And you will eliminate this intercompany sales at the selling price itself. Similarly, when you're going to consider the expenses, let's say, for example, the cost of goods sold, we also need to eliminate the intercompany purchases as well. We need to eliminate the intercompany purchase. A sale for one company is going to become a purchase for another company. Now, what I'm about to say would sound a little technical, and I think you'll be able to appreciate it better when we come to the practical illustration. But let me tell you one thing. At this particular stage, let's take a simple example to illustrate one simple point to you. Let's say, for example, the holding company sold goods to the subsidiary and the goods were costing, let's say, at 10 lakhs and it was sold, let us say, at 12 lakh. And you've also calculated the stock reserve on the unrealized profits on the unsold inventory, let's say, which is to the extent of 40,000. Let's take some figures to assume that. So let's consider that the holding company made a sale to the subsidiary company for goods costing 10 at a sale value of 12, and the stock reserve, the unrealized profit, is to the extent of 40,000. Now, what do you need to do? When you eliminate the intercompany sales in this example, you will consider this figure to be 12 lakhs. You're going to consider this figure to be 12 lakhs itself. And when you go to consider, so which means you will reduce 12 lakhs out of the sale. You take the sales of holding plus subsidiary minus 12 because this sale is a part of the holding company sale and it needs to be eliminated. But when you consider the elimination of the intercompany purchase, please be careful. You will reduce 12 lakh, but you're going to add the stock reserve, which is to the extent of 40. You heard me correct. In this particular case, the elimination from the sales will be at the entire selling price. The holding company sale is including 12 lakhs, eliminate. The subsidiary company purchase includes 12 lakh, eliminate. Don't look at 10 lakhs. Don't look at 10 lakh. You need to eliminate. The sale is a part of the holding sale. The purchase is a part of the subsidiary purchase at 12. The holding company recorded the sale at 12, the subsidiary recorded the purchase at 12. But since if you're going to eliminate 12 lakhs from sale and 12 lakhs from the cost of sale, the impact on profit is zero. The impact on profit is zero because if you eliminate 12 lakh from the sales value and 12 lakh from the purchase value, ultimately what is the impact on the profit? Zero. So you need to remember that the elimination from the figure of purchases will be after considering the stock reserve. So you need to basically reduce the figure, which is the sales value minus the stock reserve. The net figure will get reduced. So either we say minus 12 plus stock reserve, or we can say you need to reduce the net figure. I know what is now coming to your mind. So if it is supposed to be upstream transactions, would the treatment differ? No. This treatment would remain the same, whether it is a downstream transaction or it is an upstream transaction, the impact of this is going to remain the same. So I will eliminate the sales value from the sales. I'll eliminate the sales value from the purchase, but then add a stock reserve, irrespective it is upstream or downstream. Later on, when you will split the profits between the parents and NCI, you can take care of that portions later. I hope, friends, I'm very clear on the picture that what do you do in this particular case. This is one, and you get the profits out here. Now, this is one section, and once you're done with the P&L section, you now need to consider the OCI section as well. So in this particular case, the next input we're going to pick up is the other comprehensive income. So whatever is the other comprehensive income, you will also add holding plus subsidiary in terms of OCI section. So this is the profits P&L section, this is the OCI, and on this basis, you are going to get a total comprehensive income. You're going to get a total comprehensive income. Now, what do you need to show at the end? What do you need to show at the end is something important. So let's do one thing. Let's call this as A, let's call this as B, and let's call this as A plus B. So you'll have a figure of profits, you'll have a figure of OCI, and a figure of total comprehensive income, A plus B. Now watch this carefully. You need to split the profits between the parent and NCI, and you need to split the total comprehensive income in terms of parent and NCI. So what we'll do, we will segregate the profits. We will segregate the profits which is attributable. We will segregate the profits which is attributable to the holding company and the NCI. So this figure has to be split. You need to show the split at this stage. So what do you need to do? The profits of the company without OCI. The profits of the company without OCI has to be split between the holding and NCI. Now, please remember, once I go to the question, I'll explain it further. But when you are considering this split, as far as the figure of NCI is concerned, you will take the rectified profits. You will take the rectified profits of the subsidiary company into the percentage held by NCI. So we did not understand this. Don't worry. When I'll come to the question, you'll understand things as well. Right now, I'm just giving you a framework to think. So when you go to consider the share of NCI, you need to consider not the reported profits. Please mind, I'm not going to consider the reported profits of the subsidiary. I'll consider rectified profits of the subsidiary. How do we get the rectified profits of the subsidiary? We'll see in a question, but this is going to be after considering impairment losses or any additional depreciations, etc. So when you consider this rectified profits, this rectified profits is going to be, we'll have to consider certain adjustments, like for example, stock reserve, if it is upstream, the goodwill is full goodwill in nature. We need to consider the other adjustments possibly which could be. So stock reserve and goodwill will be one of them, and other ones could be like additional depreciation. Since the reported profits of the subsidiary, will be without considering any fair value adjustments and ignoring additional depreciations, you need to convert the reported profits into a rectified profits. Consider that this is the reported profits of the subsidiary, eliminate the unrealized profits upstream, eliminate the goodwill impairment if it is full goodwill, eliminate the additional depreciations, get a rectified profit, and calculate the NCI share, and the parent company can be comfortably taken as a balancing figure. This is one thing that you're going to show the split of this A. Another thing what you're going to do, we will also show the segregation of total comprehensive income which is attributable to total comprehensive income which is attributable to the holding company and the NCI. So this A plus B, we will show the split here as well. We will also show the split of this A and B as well. Sir, without a practical example, we're not able to create any image in minds. Don't worry. Don't worry. I'm just giving you basic thoughts. We will work upon a question. Let me now consolidate the picture before we go to a question with you. So when you're making a consolidated income statement, remember, you need to consider a P&L section and an OCI section and get a total comprehensive income. When you consider the P&L section, if there is any intercompany sale and purchase, forget about the fact it is upstream or downstream in nature. In this particular case, what I will do, I will eliminate the sales out of the sales part. I will eliminate the sales value out of the purchase part. I said eliminate the sales value from the sales part, eliminate the sales value from the purchase part. But remember, you need to eliminate the stock reserve. So you're going to eliminate the net figure from the cost of goods sold. And then you consider the total comprehensive income. You need to show the breakup of holding an NCI for A. You need to show the breakup of holding an NCI for A plus B. No breakup required for B. I don't need to show the breakup in terms of B. We will show the profits attributable to NCI and parent. We will show the total comprehensive income attributable to parent NCI. So when you calculate the NCI share, in this particular case, you need to consider the rectified profits of the subsidiary into the percentage held by NCI, and you can show whatever is the remaining figure belongs to the parent company. But we'll see in a practical illustration further. I hope, friends, you got the image in terms of our discussion so far. Okay, I got Shruti. So thanks for the mind maps and focus points. These not only helps us to understand better, but also helps to remember the concepts in a better way and present it in the exam. Thank you so much indeed. And he says that if it is being split between NCI holding, then it should be split likewise, Y, A, and B again. Okay. Well, in this case, you are showing the split of the profit portion without OCI. And you are showing a split of the total profit including OCI. So the presentation in terms of consolidated income statement requires you that you've got a profit excluding OCI and you've got a profit including OCI. Forget about the OCI part. So we need to show that there is a profit excluding other comprehensive income, what belongs to parent NCI, and there is a profit belonging to including total comprehensive income. So what is belonging to parent NCI? So therefore, we segregate the profits excluding NCI between the two, the profits including OCI between the two. So that is the presentation part. We don't segregate the elements in terms of just the OCI. And why profits? OCI more or less is containing a profits which is more or less unrealized in nature. So I think as a consolidation exercise, the stakeholders would definitely like to know that this is the profits, without taking the unrealized gains and losses, that is OCI. And this is the profits which is including the unrealized gains, that is including OCI. So I think the interpretations will be better for the stakeholders once they get the information that this is the profit split without OCI, this is the profit split with OCI. I hope that's clear, right? Okay, so this is done. So now I think let's take you to a small little question. We may not be able to complete the question in this case, but I'm just going to take a little run through because this is based on the previous questions. No worry, we'll consolidate the picture, whatever is left over in the next class as well. So let me just come back and take you to the study material. And we just want to do some workings at the stage. So let me just come back to the study material. So there is an interesting question in the study material. Yes, that is the question number 8. Okay, let's, I think, have a read on the question number 8. If you remember in the previous classes, I covered question number 6 and 7 in the study material. That was on case number 1 and on case number 2, if you remember that Orange County question, I guess. So I'm taking an extended version of that question. So if you remember, we did the very first question, which was a consolidation on acquisition date without NCI. And in the same question, we introduced the case of NCI, that was Blue Heavens and Orange County. So what we're doing is a little extension of that question, where we're going to see a consolidated P&L and a consolidated balance sheet put together. So right now, I'm just going to do some analysis with you. So even if the some portion of this question is left, no worry, we'll consolidate that in the morning tomorrow. So not an issue. Because tomorrow we have got a major agenda. One is on chain holding, and one is on the case of changes in ownership interest. And that's a very wonderful exercise, but I'm going to give you a Rajnikant style of doing those things with you. Trust me, you're going to enjoy the sessions tomorrow. And tomorrow, of course, we need to finish with consolidation as well. Okay, let's, I think, read the inputs which are given out here. It says, the facts are same as in question number 6 and 7, what we have done in the previous classes. Blue Heavens acquires 75% of Orange County, and Blue Heavens pays 4,500 lakhs for the shares. Then he says on March X3, that is 1 year after Blue Heavens acquired Orange, the individual statements of financial positions and the statement of comprehensive income is given. So this is the balance sheet of the two companies given after 1 year of acquisition. And then we're also given the consolidated, the individual standalone P&L as well. So let's have a look further. This is the statement of P&L, and my focus in this question is more on the statement of P&L. Now, please watch my analysis carefully, because I'm going to work upon one of the major adjustments. I am interested in calculating the NCI share in the rectified profits. That's what my focus right now is. Rest the question is easy. So please focus very carefully. You're given the revenue and the cost of sales and the administrative and the profit for the year is given, which means that there is no OCI section in the income statement. Now, it says in the additional information, Blue Heaven estimates that goodwill is impaired by 98. I think, let me remind you back that in this case, the NCI was taken at Pasna. If you remember, in this case, when I did the question number 7 with you, we took the NCI at Pasna. If the NCI was at Pasna, we can say we got a partial goodwill. And if it was a case of a partial goodwill, the impairment loss is borne by holding company only. The subsidiary is not required to bear the impairment loss. Because the NCI is taken at Pasna, therefore the goodwill impairment belongs only to the parent. Then he says the fair value adjustments to the building and other comprehensive income. All the buildings have an estimated life of 20 years from 31st March X2 and the residual value is 0. The company uses a strict line depreciations and all the inventory held by Orange County is sold in X3. Now please hear me carefully. Please go back to the question number 6. Please go back to the question number 6. I think if I'm carrying that, I am afraid I'm not carrying question 6. Okay, I think what you can do, please go back to the question number 6, open the study material and see the status in terms of question number 6. I'll tell you what is the focus points to be kept. If you go back to the question number 6, you would notice that in question number 6 of the study material, there was a building and PPE. There was a building and a PPE for the subsidiary company whose book value was 3,000 and whose fair value on the date of acquisition was 3,300. That was one. Then we can see that there was inventory. And the inventory had a book value of 500 and the fair value on the date of acquisition was 600. We're given a couple of fair values, but I've picked up building, I've picked up inventory. Rest, if you notice, trade receivables, cash or trade payable, the book value, fair value was same. So these were the only two items where the book value and the fair values were different. Now, let's see the impact of this. I am very clearly given in the question that the subsidiary's profit is to the extent of 550. This is the reported profits of the subsidiary. Now watch my calculations carefully. This is the reported profits of the subsidiary company. The reported profits of the subsidiary company is 550. These figures are all in terms of lakhs. And these figures were also in terms of lakhs itself. Now, one thing is very clear. The PPE of the subsidiary was taken at a fair value. If the PPE was taken at a fair value, that was for consolidated balance sheet, not for the individual balance sheet. So when the subsidiary company took a depreciation in the post-acquisition period, it took a depreciation on 3,000. So the reported profits which are given is based on a depreciation taken on 3,000. But for the purpose of consolidation, you've taken the fair value of this PPE. So the consolidated income statement should also consider the impact of depreciation, the additional depreciation as well. So when you go to calculate the NCI share in the profits of the subsidiary, you can't take a reported profit, which is after considering the book value of the asset. You need to consider the impact of the additional depreciation as well. So what we're going to do, first of all, we are going to make a reduction on account of additional depreciation in this case. To remind you, my focus is to calculate the NCI share in the rectified profits of the subsidiary for the consolidated income statement. So you need to consider one thing: the standalone P&L of subsidiary does not consider additional depreciation. So the reported profits are without depreciation, but the consolidated income statement will consider additional depreciation. So when you go to calculate the NCI share in the profits, we need additional depreciation as well. So we are given very clearly the remaining life of the asset is 20 years with no scrap value. So there is an increase of 300 lakhs. So we can say the additional depreciation is on that increase spread over 20 years straight line. We're going to get additional depreciation that is 15. That is one adjustment. Now, the next one, interesting. Now we can see that this is the inventory and this is the opening stock for the current year. This was the stock position on the date of acquisition, and we are standing 1 year later. So this is the opening stock in the books of accounts. So when you took the cost of goods sold, you must have taken the opening stock plus the purchases minus the closing stock. So when you would have taken this cost of sale, that is the cost of goods sold, it would have been opening stock plus purchase minus the closing stock. Now, in this particular case, when you took the opening stock for the standalone P&L of the subsidiary, you would have taken the book value 500. But when you go to consider the consolidated income statement, you need to consider the fair value of the opening stock, which means this cost of goods sold is after considering 500, but we should consider the impact of 600. So this will increase the cost of goods sold, because you would have taken the cost of goods sold based on 500, but we should have taken the cost of goods sold based on 600. So the cost of goods sold will increase by 100, and if it increases by 100, the profits will come down. So there is a need to also make adjustments on account of the opening stock as well, which will increase the cost of goods sold by 100. So we need to reduce the profits to the extent of 100, because if the opening stock goes up, the cost of goods sold goes up by 100, so the profits will come down by 100. So the impact of the additional depreciation, the impact of the inventory being taken at a fair value also has a corresponding impact on the income statement. And is there anything else? I think building depreciations taken, the changes in terms of inventory taken, and there is a goodwill impairment. But we've already seen that since the goodwill is supposed to be partial, impairment loss is not borne by the NCI. Had this NCI been at a fair value, I would have also taken the goodwill impairment as well. But in this particular case, since the NCI is taken at PASNA, don't take the goodwill impairment as a part of rectified profits. So I would take a reduction of goodwill impairment if you can say it's a full goodwill, but no reduction if it is a partial goodwill. So this will give me, you can say, the rectified profits of the subsidiary. This will give me the rectified profits of the subsidiary company. So let's have a look. So we can say out of 550, we make a reduction of 115. This comes to 435. And out of this 435, I guess if I look at the percentage belonging to the NCI, 75% belongs to the parent. So we can say 25% of this belongs to the NCI. So if I take 25% of this, it comes to 109. Approximately, it comes to 109. So in this particular case, we can see that if 109 is belonging to the NCI, we can now easily consider the balance which belongs to the parent. So this is NCI share in the rectified profits. I now like to take you to this solution as well, just to correspond in terms of what I've done. But I hope I have made sense, friends, on that. Okay, now let me just take you quickly on the solution. Though I've already done the workings, but I'll be making the consolidated income statement also later. Okay, so now we can just have a quick look at the consolidated income statement as well. Let's have a quick look at the consolidated income statement as well. This is balance sheet. I want to look at the consolidated income statement. Okay, this is again the balance sheet. Oh, that was not balance sheet P&L, is it? This is question 6. Then I need question number. I need to go to the question number. This is the consolidated income statement, which I would reflect now. Now let's have a look at the consolidated income statement, because there are hardly any adjustments. So let's have a look at this consolidated income statement. You can see we have taken the revenue of the holding and the subsidiary, no intercompany sale purchase. So 4,900 becomes a consolidated revenue. Next, the cost of sales, 1,800 for the parent, 1,000 for the subsidiary, and this is the same 100 which is on account of increase in the opening stock. Since on the date of acquisition, you had taken the stock at a fair value of 600 instead of a book value of 500. So this increase in stock will increase the cost of goods sold by 100. So we get the profits for the year. This is the profits for the year. And then there is administrative expense. Now, in terms of the administrative expense, what we have done, we've taken the holding and the subsidy. And what is this 113? One is the additional depreciation we have taken, and that was to the extent of, I guess, how much? The additional depreciation was 15. And one is the goodwill impairment. I guess the goodwill impairment was to the extent of 98. So this 113 is nothing but additional depreciation as well as the goodwill impairment, and this comes in the outer column. So we are able to get the balancing figure as the comprehensive income. Now this 1137 is to be split between the parent and the NCI. And if you look at the split in terms of parent, I've already calculated this 109, which is based on the rectified profits. I've already done the workings with you. So we can say out of this 1137, 109 belongs to the minority, the NCI. So the balancing figure belongs to the parent. So this is how the consolidated income statement is done. No worry, we will again show you a recap of this, because I wanted to give you a feeler in terms of the consolidated income statement. But don't worry, we'll quickly take a recap of this tomorrow morning once again, so that you are very clear with the position. Because first I give you how a consolidation is done. So the only adjustments out here is the increase in the stock would lead to increase in COGS. The fair value adjustments of PPE would lead to additional depreciations and the goodwill impairment. So your consolidated income statement would incorporate the impact of the fair value adjustments on the income. You take the fair value changes, you need to consider additional depreciations. You take the fair value adjustments, you need to take care of the impact of the increase in COGS and goodwill impairment, so that you get profits for consolidation. And then when you divide this profits, you need to be careful that this profit belongs to the parent NCI. Calculate NCI share based on the rectified profits of the subsidiary, and then get the parent as a balancing figure. I hope that works. I hope you've got a basic image in terms of things. Okay, so I hope, friends, I am pretty clear with this particular picture. Now, what we are left with in terms of the standard are, I would say, two things. Number one, I need to explain the concept of chain holding. First, we'll do a quick recap of this in the income statement tomorrow. Then we'll go to do questions on chain holding, or maybe we'll first do chain holding and maybe come back to this later, because time is short and we have got a lot of things to do. So I'm going to focus on chain holding. That's one. And I'm going to focus on the changes in ownership interest. If there has been a subsequent disposal or a further acquisition of shares, how does that change in the percentage of holding is accounted for? So, but do please revise, whatever we have done today, because this is going to be very important. And after the standard gets over tomorrow, you'll have a little break between the classes as well. And I would say that, do make a consolidation of Ind AS 103 and 110 collectively put together. But consolidation doesn't get over tomorrow, because we have got Ind AS 111, Ind AS 28, and Ind AS 27 as well, which is going to be followed after the tomorrow's class. Right, friends. So I think that seems to be good for the day. If you've got any questions, please ask me. Otherwise, I think that's good enough for the day. So let's see if we're going to get some more questions at this stage. But please do try these questions by hand. Whatever consolidated balance sheet questions we have done, please try them by hand once, because that's going to give you a lot of confidence indeed. Shruti sir, kindly share that consolidated question along with the answer so that we can solve it. And thank you so much for the lecture. Okay, not an issue. I will share that tomorrow with you. I'll let you know which case study is that in the GFRS. And the solution is also given in the GFRS module itself. So you can try that out. If possible, I think I'll share that PDF here itself. I'll definitely do that tomorrow. I'll do that. Thank you so much indeed. Right, friends. So I think that seems to be all. And thank you, Yadu. Thank you so much indeed. So I think on that note, we're going to take a call today, friends. See you in the morning once again. Thank you, all of you. Bye-bye and take care.